I think we're due for a bear market pretty soon, just looking at the structure of the liquidity right now. So yeah, I could see an 80% drawdown again. If you look at each cycle and you break it down, each cycle has been different. It's been different dynamics, different investors, different instruments. It turns out that the longer term investors have a lot of say in the longer term price structure and how the cycle develops.
Willy Woo is a leading crypto analyst famous for his pioneering work on Bitcoin on-chain metrics, market analysis, and price predictions.
On social media, he's got over 1 million followers closely tracking his valuable insights.
I'm not a believer that M2 expansion, global liquidity, is going to predict price of Bitcoin. Bitcoin, out of all the macro assets, is the most sensitive to liquidity. In fact, it moves before M2 moves. But once the liquidity starts dropping away, the clock has started on the cycle top. We often get misled by, say, commentators saying, look at the inflows are incredibly high, that's so bullish. And actually, the converse is true.
Hey guys, welcome back to Less Noise, More Signal. Today I'm very honored to have Willy Woo with us. It's a guy that probably doesn't need that much of an introduction, but maybe we'll do it anyways because maybe there is one or two person that doesn't know who Willy is. But I'm feel very honored to have you here with us, Willy, today. Thanks for coming on.
Thanks, Pascal. Good to see you again. I think last time was Riga just last month, right? In Latvia.
Yes.
In person. It was good to see you. Intros. All right. So I'm an engineer by trade, actually. So I had a technology career, and that's how I found Bitcoin in 2013. By 2016, it became my day job as I delved into the data behind the markets and some of the early work with on-chain analysis. Today, I run, a number of hedge funds, Crest, and I have a partnership with Swissblock and Glassnode. To basically put out intelligence data on the markets. And so that's me in a nutshell.
Yes, that's great. Yeah, we just interviewed Jan Allemann a couple of days ago and put it up online. And people were quite impressed. And I think it was well received, everything that he was showing us, the things that Swissblock has developed over, 10 years, as you said. So it's quite impressive. I think we will get into some of the topics that we discussed with him as well with you now. I think one thing that maybe I want to start with is, and you mentioned Riga, and that was quite impressive because you were up on a panel and some people asked you, or like the moderator asked you, what are you looking forward the most in the next few months? And you mentioned the bear market, and that kicked up quite a fuss, and everybody was sort of laughing, but I think you were quite serious. So maybe if you could quickly summarize, why are you looking forward to the bear market? And then also assuming that there will a bear market, or are we quite close? I assume, otherwise you wouldn't have dropped that line, so to say.
Yeah. First off, bear markets for me a time where I can kind of recharge a bit because it gets a little bit frenetic during the bull markets, and it's also the time where products can be built. And I have a few on the go currently, so it makes life a lot easier if you're building stuff. But certainly, I do expect a bear market. Markets don't go up forever. We're a late phase into this current bull market. I know people are thinking, what do you call it? A super cycle or whatnot, and it's basically going up forever, Laura. But it's I think we're due for a bear market pretty soon. Just looking at the structure of the liquidity right now, so it could be even developing right now over the last month. So it's a tricky also to know when the top is because tops are unstable, but we do get a rough idea of when the danger zone is coming, and it's been building up for a number of months now.
And what is your impression? Because I think a lot of people would agree that stuff can't just go up in a straight line, and they never do, and even though maybe in the long term it goes up as Saylor wants Laura to believe. But I feel like, what is your impression there, or your belief? is it going to be like this typical bear market that we will see where we get an 80% correction with Bitcoin? Or is it going to be like a different beast just because of the institutions that have come in? Or, like what is your, obviously it's also beholden to the market structure in general. Like if we get like a huge business downturn and a recession, then I guess Bitcoin would be disproportionately affected. But if we don't get this and it's just going to be a normal slowdown and downturn, then maybe Bitcoin can hold up comparatively well. Or how do you assess what's going to happen in the future?
I mean, the 4-year cycle is kind of a cliche within our industry because it has been for 4-year cycles since the beginning. And, if you look at each cycle and you break it down, each cycle has been different. It's been different dynamics, different investors, different instruments, and the structure of the cycle has changed a lot, yet we're still being on these 4-year cycles. One of the things with Bitcoin is that we do have this 4-year halving, right? And that is up to now been quite reliable as, a supply shock, which is an impulse of, when you have the new supply rate coming down, you get this sort of impulse and the whole system has to rebalance. Presently, that force is waning, getting smaller because the inflation rate of Bitcoin now is half of that of gold. I think it's like 0.8% or something per year. So as we go into future halvings, that's going to dwindle. What some people might not realize is that we have another cycle called the liquidity cycle, which is doing, it's just the resonance that central banks print their money at. There's times where money is plentiful when they drop interest rates, and other times where they tighten up. And historically, that's been on 4 years. And I think it's the superposition of both of these waves that have created our 4-year cycles. Now, there's this other cycle called a business downturn cycle, and that tends to be every 10 years, but it's not that, like, you won't set a clock to it. Let's say the last proper one we had was the world financial crisis in 2008. You could say COVID was one, but that was very, very, a flash in a pan, very, very quick. And, central banks printed their way out of that very quickly. And so I think the economic shape of the economy is heading for a downturn. If that is confirmed, then I think even though the weakness in our industry, let's say the infrastructure, the types of investments that are being made, anything like what we saw in the last bear market, with the likes of Lunaterra blowing up, testing the weaknesses in the entire ecosystem, Genesis Trading blowing up, Alameda, FTX. There was just this grayscale. The whole thing so had a sort of a domino effect of all the weakness points being tested. And I think this cycle, we have Bitcoin Treasury companies, they might be a little bit frothy. And now we have digital assets Treasury companies, even frothier. You might call this weakness, but I would say next to, say, the last cycle, it's stronger. And maybe some people think the drawdowns will be less. But I think when you think about it in terms of where the world economy sits, I think we'll get this 4-year cycle again. I think the drawdowns will be this time pulled down by the world macro markets. And Bitcoin being quite sensitive to liquidity is got a lot more to pull down than typical markets. So yeah, I could see an 80% drawdown again. No one really knows, but it's like, yeah, it's not out of the question. In fact, I think it's probable.
What if you could lower your tax bill and stack Bitcoin at the same time? Well, by mining Bitcoin with Blockware, you can. New tax guidelines from the Big Beautiful Bill allow American miners to write off 100% of the cost of their mining hardware in a single tax year. That's right, a 100% write-off. If you have $100,000 in capital gains or income, you can purchase $100,000 worth of miners and offset it entirely. Blockware's mining as a service solution enables you to start mining Bitcoin right now without lifting a finger. Blockware handles everything from securing the miners to sourcing low-cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day, while also saving big time when tax season hits. Get started today by going to mining.blockwaresolutions.com/LNMS. Again, that's mining.blockwaresolutions.com/LNMS. Hey guys, I just wanted to let you know I published a new book, The Bitcoin Enlightenment, co-written with my buddy Daniel and none other than Mexican billionaire Ricardo Salinas. It's a deep dive into the monetary system and its future. In it, we make the type of connections that go beyond what you'll hear from your average Bitcoiner, MMT advocate, or macro pundit. So grab your copy on Amazon today. You'll find the link in the show notes. And now on to today's show. Yeah, interesting. I mean, one thing that I'm hearing when I listen to you is really like when we think in these different cycles, you said like there's a liquidity cycle in and of itself. There's like the Bitcoin halving cycle, there's the business cycle as such, and one thing that comes to mind is really like Bitcoin has never really undergone or went through a business cycle as such, like a business cycle downturn, I would say, and I think that's why it probably makes sense for me as well to stay open to the possibility that even though there might be the liquidity cycle, they might try to extend this, through various means that I've discussed with other people on this podcast. And maybe also Bitcoin halving cycle might not be that relevant anymore, but if it coincides the positive things with this rather business downturn, if we were to get one, then yeah, I think it's just uncharted territory because Bitcoin has never undergone something like this. Is that something that you're having in the back of your mind as well?
Yeah, so we're not in our 16-year history since the Genesis block was put down. It was put down at the last business cycle downturn in that financial crisis. So we've never tested this before, and that's the interesting part. And a lot of people are quoting into money expansion, the global liquidity is going to be coming in, the rate cuts are coming. That's almost guaranteed now. So we're thinking more liquidity coming in. I think the game is quite complex now because it's in this cycle that Bitcoin is reliably above $1 trillion, presently close to $2.5 trillion. So this is now a global macro asset, the newest one we've seen in 150 years. And so it is traded by global macro participants, macro hedge funds and so forth. And it's not really, look, I'm not a believer that you sort of can just run everything off M2. What we do find is M2 is not, I'm not a believer that M2 expansion, global liquidity, is going to predict price of Bitcoin plus 10 weeks ahead, because the work that Swiss Block have been doing, my partner was looking into the data of it, is that Bitcoin out of all the macro assets is the most sensitive to liquidity. In fact, it moves before M2 moves, and for whatever reason, maybe it's traded by global macro firms that had a very predictive read on where the state of the economy is going. Maybe they're using Bitcoin as that trading vehicle, because it's high liquidity and high volatility. You get a lot of bang for buck with that instrument. I don't know, but that's what the data is showing, is that it's the most sensitive and it's the canary in the coal mine of liquidity.
Yeah, that's true. I mean, that's a great observation. M2, this is something that a lot of people on X are pointing to right now again, because we're seeing sort of this divergence, M2 going ever higher. Then you mentioned, the interest rate cuts that will be coming our way, where some people argue this is liquidity enhancing. And then they're all like, okay, just don't worry, Bitcoin is going to play catch up. And maybe it will, as it always has. I think what you're saying is that there is no direct correlation or even like causation, and maybe it's just this self-fulfilling prophecy that in hindsight it's always easy to point to some sort of overlap there, but it doesn't mean that it has to be like this in the future. I mean, the world always changes, and as said, I mean, it can be different, sort of, as I'm hearing you explain as well, right?
Yeah, I'm saying it is different. If you look at the data, you can overfit a chart and go, look, they follow each other, and now you can move it backwards or forwards a few weeks, and now it's even better. But that's what we call in our trade overfitting. You zoom out across 30, 40 years, does that still work? Because, a localized, a localized touch point on M2 chart on Bitcoin might look wonderful for a while until the correlation breaks.
Mm. Yeah. No, that's definitely true. I mean, you were speaking of the 2021 bull market and then the following bear, and there, obviously, in hindsight, again, we can point to these sources of danger, that we had, FTX, Luna, all these like really blowing up. Would you say that in the current market structure, you already hinted at it a little, but are there any similar hotspots or sources of danger that are of similar magnitude, which we don't know yet, but maybe some people are pointing to the treasury companies, and some obviously say Michael Saylor with strategy could be the big problem, blowing up and dragging everybody down. To me, this argument doesn't make that much sense. And also, I think that's something you said as well, and others. This market is more sustainable in the sense that it is like spot driven nowadays again, a lot more because of the ETFs and the treasury companies vis-a-vis like the 2021 bull market and then blow off top that we had. But yeah, do you see any similar danger zones, so to say, or sources of danger, we could point to as of now?
In the treasury companies, we do need to see what will they be liquidated. Something like MicroStrategy, which has been using now 8 to 12 year out debt, meaning if your price is dropping into a point where you'd normally be liquidated, well, you've got 8 to 12 years for the price to recover to a point before you have to, sell your Bitcoin to pay the debt holders their capital back. That's very safe. We're looking 10 to 12 years out of Bitcoin. Will it climb above the current price? So I think MicroStrategy is very robust around that. And the latest way they're doing it is with preferred stock, where there's not even a debt instrument on it. And so I think that's okay. There's been a lot of copycats that are trying different structures. Metaplanet, I think Metaplanet could be liquidated if they time the market wrong and end up with a big bag of debt and can't sell through it to pay it off if the market turns, and some of the treasury companies are using 4-year debt and so forth. So we need to really see, it's very individual, and that's the Bitcoin treasury companies. And there's a whole host of, Ethereum, BNB, a whole bunch of digital assets that are now starting to roll out. And we know those assets pull back often above 90%, 95% in the bear market. So will they be liquidated? If the question is if they will be liquidated, that'll really hit the markets, and those coins that are locked up will then be dumped onto the market and cause some calamity to the holders of the direct token assets. It's different if you're holding the shares, the securities. You're going to be exposed to MNAV compression, and so if you say Metaplanet was trading at 8x MNAV, it's pulled way back from those earlier days, but at 8x, you could expect that to compress to 1x at the bottom of the bear market. So that's let alone the underlying value of its treasury of Bitcoin pulling back, right? So if you're riding that stock, you can expect that to come down quite a lot in a proper bear market. So, but yeah, I see that as the weakness, the cycle. One is the shares, but that's kind of like a MNAV buffer. It doesn't mean coins will be liquidated. If the coins get liquidated, they get dumped back onto the market. I mean, that's quite different from last cycle where we had an $8 billion fraud and, people going to jail and masses of coins being dumped back into the market as these things went but the actual infrastructure was broken. It was illegal. There was a whole lot of problems, and the whole thing unwound one after the other, cascading.
Yes, I see. I also heard you say on treasury companies that some of them might be interesting shorting opportunities in an actual bear market. That just because the way they're structured. But then my question would also be, how do you think about the industry as a whole and its future? The industry of treasury, of Bitcoin treasury companies. Is there a future for them that you can see that they can function and work in a future world? Or what is your general assessment when it comes to these companies?
If the Bitcoin treasury companies work as intended and you're tapping global bond markets to feed capital into Bitcoin, then that's a benefit. If that is actually being done, I'm sure some of this is coming in. And the question is how much of it. How much of it is from holders selling their Bitcoins to buy this more volatile asset for a bigger gain in the bull market? If it's the same capital recirculating, that's not beneficial, because ultimately we want two things for Bitcoin to be impactful in this world. One is that it remains decentralized, so it is a sovereign asset and it's a proper decentralized money, not under state control. It's a separation of money and state. And on that theme, you've got the centralization of supply of these treasury companies that can denationalize, and that's a vulnerability. But also, Bitcoin needs to be big enough, right? What's the point of having let's be extreme, a $1 million asset as a global money? You can't even buy a house in most places in the West with the entire market cap of this asset, right? If it's 1 million. So you need to scale this up, right? And typically $20 trillion is where real money starts to come in. And I think above 20 trillion, you start to really impact the world with this asset. And so that needs to happen. And treasury companies, spot ETFs, these are all instruments where the large capital pools are comfortable with. So they do open that door. So it's a trade-off. We're trading off decentralization. We're centralizing the supply. It's vulnerable to nationalization attack, but also we're allowing the inflows to get a lot bigger.
Yeah, it makes a lot of sense. I mean, it's probably the inevitable way, or like to just say inevitability to get there. To have these treasury companies take part in this as well. Just because it started with the private individuals, and it's now moving over to these institutions, and then maybe at some point even the governments. That there will be another cycle, maybe in the next cycle, where governments will go all in. But I mean, I had this very interesting article that I just recently read, and it was speaking of it's like the gold rush area for Bitcoin, because Bitcoin is still in this monetization phase. Everyone tries to get as much Bitcoin as possible. And with these treasury companies, as Michael Saylor showed you, you have maybe the first phase is you issue as much stock as possible, you delete your shareholders. This works in a hype cycle to get Bitcoin onto your balance sheet. Once you have it, you do debt issuance, you give out preferred shares, and you only hit the ATM to sort of pay, not back the principal, but so obviously the interest on these products that you issue. And maybe in the third phase then, and we're not yet there, it's really that some of these companies who have strengthened their balance sheet with Bitcoin might become productive and use Bitcoin productively. And my question would be, do you see such a future where maybe also Bitcoin treasury companies, they almost turn into the new type of banks of the future, and maybe turn to people like you and the fund that you have, hedge funds, to productively earn a yield on Bitcoin, and so do you see that's a possibility, and that they will be like the demand side for products like you have, and for other hedge funds, who do a great job in maybe providing yield on top of Bitcoin?
Yeah, I mean, it's certainly there's a lot of value to having a big bag of Bitcoin, right? And there's two paths with that. Do you want yield on Bitcoin, where you use it as collateral so that you can do some amount of yield generation. Typically, that might mean trading around markets, using it as collateral. And the other way of using your Bitcoin, so that's as I got some Bitcoin, I want more Bitcoin, by climbing up the risk curve, because you're trading now and you're giving your Bitcoin onto people to trade it, and it's sitting on potentially not robust exchanges. So you're taking extra risk. The other way of using Bitcoin, again, as collateral, is to front it and borrow against it. So these are for the investors that want to, follow the pattern of the wealthy, which is never sell your asset and use your asset as collateral so you can borrow, see it to live your life, which is debasing towards zero. And so those are the two uses. I think that it's already started, that there's an infrastructure and an industry developing using Bitcoin as collateral. And we've seen Cantor Fitzgerald reserve $2 billion of liquidity, US dollars, to lend to Bitcoiners. Freddie Mac, Fannie Mae, who dictate a lot of the lending market in the US, are now accepting Bitcoin as a balance sheet item for a borrower when assessing risk. And so these steps are starting to happen, and the TradeFi world is now starting to recognize that this is an asset, and it serves a very good purpose as collateral. So I totally see a lot of use for this. I don't know the complexities of what a public company may and may not be able to do with Wall Street, but I can see there's great value in it. I also see there's great risk for Bitcoin as an asset, because if you think about Bitcoin getting larger and larger and larger, who is the competitor? And that is the central banks that print fiat. And so it does mean there is a power shift, and during a power shift, we've seen all sorts of things happen. A nationalization of an asset such as gold in the 20th century, and converting that into fiat by closing the redeemability of paper notes for gold, has happened before. And so I think it's a very real risk down the track. It might not be this rosy future where we have a great treasury company. It's a Bitcoin treasury company, and it can do all of this great stuff with the asset. We need to think about, where does that put the state, and what are their options, and what are the risks around that?
Yeah, it's definitely the adversarial thinking that Bitcoiners still have and never want to lose. But do you see any difference there to the gold nationalization? Because Bitcoin in the end is software. Even though it might be held centrally and in a centralized way, it's still, you cannot really mess with the protocol itself. People could try to maybe even vouch for a hard fork if that were really a problem at some point. If people were like, if Bitcoin was held with all these treasury companies and they would try to manipulate its supply or something like this, or do you say, okay, no, it's just going to end up the same like gold? It doesn't have any difference in that sense, and that's why it's a real risk that this could end up being a losing trade as well in that sense.
Bitcoin's the one thing, a number of things going for it, but the one I'll focus on this discussion here is that Bitcoin can travel across the world at the speed of light, right? So it is a good medium of exchange. It's just, other than the price volatility, and gold wasn't, because it's very hard to ship a gold bar across the world to settle trade. And so we needed a paper layer 2 called notes that are redeemable for gold. And that means that the supply gets centralized. Let's call it Fort Knox. And it's there's one entity, a nation states, saying whether or not that gets redeemed. All right. So that became a very fragile structure. If you look at 6,000 years of gold and silver as money, medium of exchange, and the store of value, just holding it, the value of holding it, were united until the world got complex with the Industrial Revolution, and we needed to separate the medium of exchange, because shipping gold, lumps of gold, does not work. But Bitcoin, you can have this with the medium of exchange. And once you get that, the whole thing becomes robust. It's very hard to tear the medium of exchange out. from the unified money in there, whereas gold was not capable of doing that. So that's the path we want to get to, and we want to get to that end goal without having big pockets of the supply under a digital Fort Knox and controlled. Because once it goes there, it's going to be very hard for us to reverse that. Sure, you can say we can hard fork this. I'm sure you can do that as a development project, but what does that mean for the entire world that is using the current Bitcoin and the regulations around it? The real world that we live in that are governed with governments and armed military and prisons to go to and, edicts from countries. The practicality of just hard forking it's no longer a cypherpunk situation where it's at the early stage. It's now at a very developed stage and a mature stage. So then if this future happens where it gets nationalized, then you've recreated the gold standard. It's called the Bitcoin standard. It didn't really take off. You might back the US dollar by Bitcoin. Maybe you do that and then you close the redeemability and then you're back to fiat again. So, now it's going to be harder for the next time we try this experiment.
Yeah. No, that's definitely great, and a sense of rationality that you're spreading here. Because, like, to me, this is also something I'm struggling with, because I figured Bitcoin would be this very unique thing, that will never be manipulated in that sense. But yeah, you're right. We're in the real world, and in that sense, it might not be stripped away completely from politics, and that's also where I started to grow somewhat appreciative of what people are doing in the US, all these like political endeavors to maybe also try to steer the political system into the right direction, even though I would prefer if we wouldn't have to go down this route, because it would be more cypherpunk reality. But it's just, as you said, it's the reality of life that politics is still a thing, and even Bitcoin doesn't really obsolete it in that sense, or at least that's my feelings. Yeah, definitely something for people to appreciate. I maybe want to come back though to, the more liquidity driven dynamics and then capital flows. And I know I had some questions prepared that I sent up front, and I know that a lot of this is probably a proprietary IP that you won't be able to share, but I can't help picking your brain on this and try to see what this episode allows, because I'm hearing these terms all over again, liquidity flows, capital flows, volatility structure. And maybe if you could define each of these terms for us, what are we looking at if we talk about liquidity or liquidity flows, and what goes into this? That would be interesting to hear your perspective for sure.
Yeah, so there's many definitions of liquidity. There's a classical sense for a trader, which is effectively the depth of the order book. If I sell $100 of this asset, how far is the price going to slip? The slippage. What if I sell $10 billion of it? How far will the price move? That's liquidity, as a depth of the order book. That's quite a term. It's related to when we talk about liquidity flows. Generally, I would just picture capital as a liquid, and where does it flow between buckets? Is it flowing from the gold bucket to the real estate bucket to the Bitcoin bucket, from the Bitcoin bucket to Ethereum bucket to Solana bucket to the mid caps, the low caps? And so here we're looking at capital and where is it moving to. We can even talk about global liquidity, which is fiat money printed by the central banks, and as that money is printed into existence, it becomes a pretty bad asset. So it flows, and this capital flows into these, wealth preserving buckets like real estate, Bitcoin, gold, so forth. And so that's the premise of when we talk about liquidity flows. That's what we're really like looking for. And in markets, it's somewhat highly obscure or opaque because all you see is a price ticker. Particularly, historically, the rich don't tell everyone, this is my wealth and this is where I'm putting it, and we don't report it everywhere. That would be one way to figure it out. Another way to figure it out is the price is going up here and the price is going down here. I think someone's moving some money around between these buckets. And so now it's like, how do you measure the flows of liquidity? There's, we need to look at the techniques of how we do that. And this is now another term. We have another term called capital flows. Actually, it is liquidity flows, but because Bitcoin has a blockchain, we can make a pretty good estimation of when coins move from one wallet to the other. And we can estimate this amount of money moved between wallets when we make the assumption it's going from one investor to the other, or more likely one investor to an exchange. Trades start happening and it goes back to an investor, a long-term investor. So when we're looking at capital flows in the Bitcoin network, we're actually looking on-chain to see where the capital is moving. Is it moving into, say, a ETF instrument? Is it going to which is an investor? Is it moving from an old investor to a new investor? We can look at the price at which they bought it at and what the current price is, and from there you can do a calculation of the new flow that came into Bitcoin, because the new investor bought in new capital and we know what the price is. So I term this capital flow because we're actually measuring the capital coming in, but that's not actually a full picture, right? Because this is only capturing the movement of coins between a wallet. It could be an investor that just has their wallet on Coinbase and they just bought some coins, but it doesn't do anything on the wallets. That estimate's missing. And so ultimately you get down to the pricing structure. That buying of coins and that selling of coins and how that came about has an impact on the price chart. And so ultimately it comes down to a blend of many techniques, one of which is on-chain to get a very dialed in liquidity flow, you could say, of one cohort called a long-term investor. That long-term investor holds a self-sovereign wallet or is using an instrument called a spot ETF or a treasury company, and you can see that impacting, and we can measure it, and I call it capital flows. And then you can overlay what are these guys that are doing with wallets that are on Coinbase, or what are hedge fund managers doing, what are traders doing. These are all impacting the liquidity, and that you can only pick through the pricing structure. And ultimately it comes down to understanding the volatility structure of price and overlaying these two dynamics that we have, particularly in our industry. You don't have blockchain and gold, so you're basically down to just the pricing structure, but we do have both.
Yes, I was just going to ask this, because it feels like this is where it's distinctively different to traditional assets, because in traditional assets, you don't have a blockchain, and then you're maybe left to exchanges. And as you said, the volatility structure, the pricing data, which maybe is also sometimes probably hidden away in some dark pools that we don't even know of. I guess this is probably some of that is the case in crypto nowadays as well. You would argue that because of the on-chain, the blockchain we have, there is another element that maybe lends some more transparency to what is going on here. And as a sophisticated trader with a lot of experience, you can maybe take advantage of this and make use of this on-chain structure, at least because there is some more transparency available,
exactly.
right?
Exactly. So it's actually quite a high resolution picture of one cohort of the market, which are the longer term investors. And it turns out that the longer term investors have a lot of say in the long term price structure and how the cycle develops. So it's a very important picture and it's a high accuracy picture. And then when you layer up multiple blockchains, and you can then start to make an estimate of capital leaving one network and going into the other.
Yes, I see. That makes sense. I mean, I do understand now liquidity flows and capital flows from a bird's eye perspective, but maybe in terms of volatility structure, the pricing structure that you mentioned, what is it that you're looking at there? What does it mean, like the volatility structure of an asset? Is it how the price evolves over a time frame, or what does it mean if I look at the volatility structure of something?
Well, in broad terms, how the price bounces around, the patterns in which it bounces around, you can tell other things, right? If we're going sideways, for example, if you're going sideways, and with very little volatility, it could mean many things. It could mean, you know, an investor's come in and said, look, that's a good price, I'm buying. And I'm going to buy a big chunk. And maybe I'll buy $1 billion or many billions of dollars. Actually, and I'll put my order in. And whenever the price wants to drop down, it doesn't drop down because he's filling his order, right? And so you'll see that, for example, the bottom of a cycle is often met with a very reduced amount of volatility, because actually investors are coming down and they're bidding and they're buying and they're filling their bags, and volatility is coming down. And near the top, liquidity drops away. The price is running up on sheer momentum and frenzy, but actually the liquidity, the flows aren't keeping up with the price. So you get this divergence between how the asset is priced and what the investors are really doing. And so what you get is an increase in volatility, and things are chopping up and down, because there's no liquidity buffer to bid and fill the bags of the asset as liquidity is dropping away. So there and is an example of how the price moving around changes. The volatility structure, how the price moves around, is starting to give you an idea of the liquidity in the system. And so that's just in a simple term.
Yeah. Okay, I see. And that makes a lot of sense to me as well. But I mean, if I wanted to maybe track stuff like this myself, and obviously this is probably too much that I ask for here, but is there a way that you can sort of try to assess the liquidity and volatility structure yourself? I mean, when it comes to the capital flows, again, I feel like, okay, nowadays I do have on-chain data that is available, or I can at least get to the data. I know where it's available. Stuff like Glassnode that you mentioned is providing a lot of this data. But then again, when it comes to like order books and just the pricing structure at exchanges, is this also available in some sense, or is it the case that in that sense we are beholden, like the normal retail traders, to people like you and others who do this for a living, and really have the access to these type of
I mean, like everything, the more components are there, Glassnode. You think about Swissblock, they were trading with this type of data since 2015. And by 2019, decision was made that this is great. This is low hanging fruit. Now, 4 to 5 years on, there's much more sophisticated models and know-how. So the low-hanging fruit was spun out for the world to use with Glassnode, and that's inspired a generation of analysts to use this data to build new models. And some of these models are useful, some are wrong, and some are terrible, but some are useful. And it's the same thing, right? The pricing data is there to understand it and work with it. And it's now been 10 years of knowledge between Swissblock and myself to make sense of it, because there's so many paths you can go down, and it may work for a while, but it might not be the full picture, and it can be you're using the wrong type of data, and all that stuff is like an artisan doing their job. You learn the trade. Unless if you're a retail person, and if it's something you want to rabbit hole down to and do that, let's say apprenticeship, or put in the years to get the understanding, then it's available. It's available. The data is available. People talk about it. I'm on this podcast discussing how we think about it. And so it's going to be a lot quicker now to learn this than, when I got started, when we didn't have anyone providing the on-chain data and giving insights to how it all works. So absolutely, it's easier now than say 10 years ago. But the time needs to be done to understand the liquidity. And I don't expect 99% of the population to go down that path, 99.9%. And that's why we've, wrapped up a product, and we've created the models, and we've layering that with our knowledge of interpreting the models. And we've created, the Bitcoin Vector Lite coming out on Substack, and these reports. And actually we wanted to do this because we could see the trade file of this world coming into Bitcoin as it grows to represent the data behind the space. We've been doing this for 10 years and we thought, let's do this now and provide the insights from within our industry with the Bitcoin ethos. So that's why we're doing this, even though Swissblock has been trading these markets for 10 years successfully, with high success. I don't know if Jan spoke about it, but in my opinion, they're one of the top trading firms within the industry, kind of the secret trading firm no one knew about because there was no reason to say much of their own capital. And thus Swiss by nature and private.
Yeah, which resonates with a lot of people as well. I mean, and you're right. The demand is there. That's definitely what I can see as well with my podcast and just like with people I talk to. But in the end, you're also right that a lot of people might not be willing to put in the necessary time to work through everything. And if it has taken you guys more than 10 years to come up with this, then it's probably better for most of the people just stick to something like the Bitcoin Vector Lite or stuff like this that you mentioned, so they can sort of get a glimpse of what this is all about. But I know that you yourself are also tracking this data, I think with your own metrics that you have. And I remember you regularly sharing like these 3 charts, the liquidity index, the macro cycle risk model, and maybe the Bitcoin network flows, if I recall it right. But if you could share some of this right now and just explain where are we at right now, when we look at your models, what is it telling us, in terms of like, as you said, we're late stage cycle. That's maybe something we can read from the chart, but then also like right now, Bitcoin is hovering around 112K, I guess. And people are wondering, is this now the bottom? Are things stabilizing? Yeah. Can you talk to this as well?
Yeah, maybe I'll share a screen. Okay, so this is a macro cycle risk model. But ultimately, this signal is picking up on liquidity. Underlying it is the core liquidity model I use. And so when it steps up high, that's an area high risk, which means that the price is running away without the underlying liquidity support. I mean, you can see as we approach near the tops of the market, we get into a high risk zone. And there are dips, which are environments where, we can get recoveries. And then once we're at bottom, the liquidity comes in and the risk drops. And you see this back in 2017. And you'll see that even as the risk rises, liquidity is dropping away, but the market gets quite frenzied. And so we started the rise, say, in 2017 when the price was only $2,500. It ran to 20,000. So, but once the liquidity starts dropping away, the clock has started on the cycle top. And so, there's a more zoomed in picture here. You can see as liquidity comes back and the risk drops, we're structurally good with investors coming in. And so we're actually right now in a little zone where the prices pull back so much that the liquidity underlying it is starting to look okay. And so it's sort of dropped a bit and it's going a little bit flat right now, which is quite unusual to see. You'll see again when we broke all-time highs, the liquidity started coming back in and it was a healthy structure. And then in actual fact, a lot of speculators jumped on and liquidity started falling away, and that created a locally bearish area. So it is quite sensitive, this one.
If you zoom out on this one and we just look at the current cycle, assuming it started maybe in late 2022, obviously, I think, we hit.
Yeah, right there.
Yeah, exactly.
Right there, January 23. But yeah, in late 2022, liquidity was starting to come in right at that 16,000 bottom.
Yeah.
As that started to really zero in, we had the liquidity come back in and that picked the top, the bottom.
In 2024, we had this first peak there, which wasn't at the exact upper bound, right? Around there, it was March, a little, like maybe it was in June, I guess, where the risk were the highest. But now in early 2025, we had it hit the upper bound. Would that be in your mind now be okay? as you said, the clock is running now. We know, okay, we are in the late stages because we hit the upper bound for the first time in this cycle, so to say. And now, as you showed in 2017, it can go on and the price can also run for several months still. But we know at the time sort of is running out, and we should be to later cycles, so to say. Is that how you're reading data from
Yeah, I'm
this?
seeing it. I'm seeing it as a timing signature to a top. Another view of it might be this one, right?
Mm-hmm.
Because it is closer to the liquidity model that powers it. And this is the liquidity index. And generally, when we drop below this standard deviation line here, that's pretty close to the top. And our last cycle top was when it crossed this line was right at this zone here. And the investor liquidity dropped away. It stabilized here and allowed a recovery, but know that this recovery was actually from derivative paper really pumping in. And so a lot of open interests are buying that forced the price up before it finally fell away. So I kind of think of this as a dead cat bounce. The investors had left. The paper was pushing it up before it fizzed out. And that's the 2017 top around here.
Yeah.
Okay. And it was much more of a smoother bear market in terms of liquidity coming and falling away. And where we are now is
we're below the dotted line already. So that's something to be wary of.
It's a highly dangerous zone. And if you were to look at what we talked about in terms of the capital flows, here we go. All right. This one's easier, right? You're just estimating on chain the capital flows coming in. I'll turn off the leading signal. You will see that higher price, higher flows. And now we had a higher price with not the corresponding higher flows. So you know something's wrong here. You know that this is not supported by investors. And so this is a very dangerous structure right now.
I think
to recover, we need this to go higher.
Exactly, because I think the way to read the purple area here as well is also once it is already very high, this means that the capital inflow, the rate of change it's inflowing is quite high. So in order to sustain it, we need high capital inflows, So with that, it's probably better if the purple line is lower, because that means the probability of it going higher might be better, so to say. Is that a correct interpretation?
That's the way, because we often get misled by, like, say, commentators saying, look at the inflows are incredibly high, that's so bullish. And actually the converse is true. When the flows are high, it's incredibly dangerous, because the price moves, you can see it on this chart, the price moves with the rate of change of flows. If you think of it as like a skydiver practicing in a wind tunnel, and the fan, the RPM speed, the updraft is the flows, right? Well, that skydiver is going to float higher up in the wind tunnel as the flows get increased, right? And that's what the price does. And so as we're peaking out at here, $2.8 billion a day coming into the network, if that's not sustained, then it starts to fall away. Now it's like 1.5 billion a day still coming in, but it was 3 billion just the other week. So that creates a bearish environment. So it's kind of, it's kind of converse to what you immediately think. And let me show you the last cycle top. We did the same structure. We went higher, and then we had a lower high. This was the paper top. This is the top, which was not valid. It was not supported by the investors. And so what I'm saying here is we're in a very fragile structure. Given the liquidity measurement, the clock is ticking, and it's well deeply into the bull market. We're very deep into it, and liquidity is falling away. We're in a high risk zone. I'm not saying that that's the start of the price running down. I'm saying that the investors are not here, and you can see in 2020, tail end of 2021, we did get a higher high here. But if you were to look at the liquidity model, we already started peaking here and we crossed this line. It was dropping away. In the capital flows model, this was this was the fundamental top for investors, and we did get a little bit more flows in, but this was really pushed up by not investors. It was by the paper markets. And if you were to, there's many views of the parts of the market, but here I will show you what was happening with the paper. And let's go back to this zone here. The investors fell away, and you can see paper started coming back up here. This is the speculation chart tracking the paper. And so that was what was powering it. So right now, what's developing in the Bitcoin market is a weakness with investors. And if we don't get these flows high enough, then we're in a divergent state where price is not being supported. And that's very late cycle. And maybe we pull back, and maybe we run up higher like we did here, but it's not got the legs for a fundamental healthy structure. And you can bet on the bear market being just around the corner at that phase. And so we've got a few weeks to recover here. If we don't get that, then we're starting to get into a very high risk zone. September, October will be telling.
Yes, for sure. Well, that's a great explanation, especially like as I'm hearing you, it's not necessarily the total flows which are the most important, but sort of the rate of change of capital, coming into the network. And this is what you want to track like the closest if you're like sort of a tactical investor that's really trying to time the market, so to say, and then maybe also hit up these capital flows with the pricing structure again that you mentioned, like if we were to get another inflow swath or wave, then we want to also compare it again to the pricing structure. Is it stabilizing with these inflows? Is it really just jaggy, which would then again, as you explained, be an implication that maybe some of the market makers have left the market already, and that's why it's more volatile. So I guess that's probably painting a full picture, as you said, like putting all these different indicators together and try to find some confluence. And it's never probably just one thing that you can point to and say, okay, now we're going higher because of this. So that's definitely worth understanding. Well, I think that's very interesting. I don't know if you have anything else to add on this.
No, I think that's a good summary, is that it is really important to see the fuller picture. In this case, we might even say, like, where is the capital gone? All right. And actually the capital is going into Ethereum. And so like if we retract these flows here, we're looking at the flows into Ethereum now, and you can see that's rising. And the Bitcoin flows are dropping. And so this is where some of the work of Swiss Block, because they're doing many, many different signals around how does it move around the altcoin ecosystem. Their signals give us a really good view of the entire flows across the crypto ecosystem. So, but right now, a lot of the flows are being diverted into Ethereum is the reason why this is not peaking as high right now.
Yes, yeah. Oh, that's great. We will definitely link back to the episode that we did with Jan, where he gave us a deep dive on how Hawkeye and everything works that they've built. So, Willie, yeah, we've gone almost an hour, I guess. Yeah, we're coming up on the hour right now. Maybe one last question that I would like to ask you, just because of curiosity as well. The work that I do as an investment manager, I also do see like a lot of hedge funds coming into the market. I haven't been in that space for quite some time, so I can't tell the difference to earlier. But it feels like this market is getting crowded as well. Like on the sell side, so many are trying to find liquidity and capital to move into their products. You've probably more than anyone seen a lot of competitors and a lot of people in that space. What is your general assessment of all these crypto hedge funds? Are they worth the buck, or is it very highly concentrated with a few that you want to dabble in? Or yeah, what's your overall assessment?
Yeah. So to be specific, Crest, the fund of funds operation. So we have three funds, and these funds are actually, our day job is to assess managers, hedge funds, basically other hedge funds, on their robustness and their suitability to create a portfolio out of. And so it's our day job to see how good these managers are and whether or not these strategies are suited for for our needs. And we are a liquids alternative branch of hedge funds. These managers are quantitatively trading the market. And in our case, we're generating yield, whether it's against US dollars or versus, Bitcoin, whether Bitcoin yield product. And we're allocating capital or capital allocators to these managers. And then, there are other types of hedge funds, right? There's the venture capital hedge funds. There's many different strategies. Some people are just buying bags of coins and writing those up under indexes. And so be aware there's many, many different types. And my specialization is in the quantitative trading side of things. And we generally shoot for even a subset of that, which is the market neutral, where we're playing arbitrage. So we're not taking directional risk. We track over 700 hedge funds and their performances, and we do due diligence across them. I would say that presently the majority of managers, hedge funds that are trading directionally aren't ready for prime time. Their models are overfitted, meaning they are working until they break and then they start to lose money very quickly. And that's a big danger with directional trading strategies in general, where, it's particularly Bitcoin in crypto markets is they're still in their infancy and they're constantly changing their structure. The market is changing its personality every 3 months. So it's very hard to build a robust model around that. And that's part of the problem. So we've steered away mainly from too much directional hedge fund managers. In fact, we try to cap that. The directional trades always sneak in because fund managers like to throw that in. And it's our job to try and keep away from that, because right now the inefficiency within the crypto markets are still pretty good that you can get a nice, 2, 3, 4, 5 times multiplier on T-bills. And
Yeah.
so
Yeah,
that's good for
exactly.
us.
Can you maybe concretize this? Like what do you mean by they have overfitted their models and then it works until it doesn't? Is there like a concrete example that you maybe can give how a fund can really overfit their models?
Yeah, so when we say overfit, you have you create a strategy, you go, XYZ happens, I'm going to go long or go short because of ABC. And when you run a backtrace on the existing data set you have, and like, oh, look, I made money. All right. And then you get another bit of pricing data from different date and you run it forward. And hopefully it should give you roughly the same returns, right? If it doesn't, it means that you've fitted all the parameters of your strategy, A, B, and C, and X, Y, Z. We're so tightly constrained around that picture of the price chart that when you set it loose on an unknown picture, it didn't work and it was overfitted. And then the real thing is, when do you do this on the real life market? And then the real life market is something you've definitely never seen before. Did you overfit it? And now, how sensitive is it? How robust is it? And now how is the market going to respond back? Because you're going to make a footprint in the market. Maybe you put too much capital in it, and and it is basically bot wars and trader wars with humans in it, and they're all fighting out a zero-sum game. And so it gets very hard to make a very, very robust strategy that is hooking into maybe some real behavior of human psychology or of the market, such that in 5 years' time, in 10 years' time, in 1 year's time, it's still valid when you realize that the crypto markets are changing because, MicroStrategy came in and started buying bullets, big $1 billion bullets of Bitcoin. And then, the perpetual swap back in the day came out and the derivatives started to push the market around. And now we've got, an Ethereum Treasury coming in. And so they all have footprints on the market. And if you fit your whole strategy on something in the past when that was not the case, and then you run on a live market and it's chaotic and ever changing, did you build something that works in this newly structured market that's changing every 3 months, which is the challenge within crypto markets? It's very, very difficult to build these strategies.
Yes, no, very interesting because that's a train of thought that I've been hearing from other people that I've interviewed as well. And I mean, it really starts on the macro level as well. I just had this recent interview with a guy who was really adamant about the fact that like a lot of investors on the macro level are still clinging to the gold backed era, and they're applying a lot of their models as if like our money would still be applied to gold, which is not, and then maybe you have to recalibrate your entire framework there as well. And so it starts on the macro sphere or level, and then it moves down to different markets. And as you just explained, even Bitcoin and crypto itself, it's changing by the weeks or months, how everything works. So I think that's so important that you stay vigilant and really try to understand what's actually driving the market, because if you cling to, as you said, some wrong, if you have some wrong inputs, then obviously it's not a surprise that
Well,
your
I
output
would
might not be
say,
correct.
we started doing this, and in the early days we got our asses kicked, and then I approached a friend who ran a $4 billion quant shop and was head of research, and he's come on as advisor how to help us diligence how robust these strategies are. And he's trained over 1,000 quants on how to build these models to trade it at the highest level. Even if we get an A on the diligence report, once this thing starts running, I can show you the track record. A lot of them break. And that's part of the reason why we do market neutral, to get the stuff right, even from the pros that have done it at the highest level in TradFi. Incredibly difficult on these markets. So yeah, it's a tough thing right now. I think we will stabilize. The structural market will become better. But for now, 95% even of these strategies, we're yet to see if they're ready for prime time. And that's been 3.5 years of learning.
Yep.
Yeah.
No, definitely good advice here as well. Well, Willy, thanks a lot for doing this. That was very interesting for me. I learn a lot whenever I talk to you, so much appreciated. Enjoy the rest of your day, I think, in Europe, and then hope to see you soon again somewhere in the world
It's been
of
great.
crypto.
Been great catching up, Pascal. I look forward to our next encounter.
Yes.
Thanks for having me on the show.
Thanks. Have a good one. I'll be linking to everything you mentioned, and then enjoy. Bye, Willy.